Financial independence. We're going to talk today about financial independence, what it is, how it can make a huge difference in your life, and what it takes to be able to get there. So our topic is the 6 steps to become financially independent. From my experience, this is it. There are 6 main steps to do it. First, a quick disclaimer. This basically says that if you take the advice from my video here and go off and do it yourself and screw it up, you can't sue me. So, all right, so what are we going to learn today? We're going to learn my insight into what the important ideas you need to know to manage your money effectively or confidently. So this is not a deep dive. This is just an overview, the big picture. There's a few things that I think that people really need to understand to be able to be financially independent, and that's just what I'm covering here. We're going to find out why a financial plan is the answer to your money worries, which may surprise you. And we're going to learn some effective investing, the right mindset, and some cool strategies that can help you live the life that you want. So, now, why should you listen to me? Basically, I'm a financial blogger and a fee-for-service financial planner. I've been blogging for more than 10 years and almost 25 years as a financial planner. The big thing is that I've helped nearly 1,000 families develop detailed personal plans for themselves. And by going through this process so many times and finding out what really works, I've developed a big insight into what actually accomplishes this. I'm also a numbers guy. I'm a certified financial planner and a CPA accountant. And so I don't just talk in generalities. I work out the numbers and make sure things actually work. And I've become the expert on a few really interesting financial strategies that can make a big difference. So, all right, so what is financial independence? Basically, it means work is optional. So you have enough money to live the life that you want without having to work. And at that point, what happens? Life changes. So it's not really about the money, it's about your life. So we had one client that when I told him that you're at the point, you've made financial independence with what you have now, you don't have to work, you could just retire and live off of it. But he wanted to keep his job, but he made a point, went in, talked to his boss and said, you know, my financial planner says I can retire today, so you better be nice to me. And it's actually kind of cool how it changed his life and his whole outlook on life. So he still stayed with his job, but now he was there for a different reason. And it's this freedom, that's the big difference that financial independence can make in your life. So now there are 6 steps. All of these need some explanation, and but I'm just showing them here just so you get a concept of where we're going with all this. So first of all, you need to understand your inner motivation, and that's important. Get a professional written financial plan, and I'm going to explain what a plan is and how it is that it helps you specifically. And then we're going to talk about the effective investing that you need to know, the few things you need to know to be financially independent, the right mindset, because your mind can actually mess you up much more than you may think. And we're going to touch briefly about some interesting strategies. And then you need to work with a planning-focused advisor, and I'm going to explain why that's a benefit for you. So now step 1, understand your inner motivation. So what's important about money to you? I like to ask every client this question, and it's very important. So the most common answers are security. I want to feel secure financially, not worrying about it. I want to be free to do what I want and not have to worry about whether I can afford it. For me, it's self-confidence. You know, having a big chunk of money makes me feel confidence. But whatever it is for you, it's important to understand what it is, because you may ask, like, what really is the difference between financial security and financial freedom? And the answer is, it feels different. And that's what it's important for you to know what it is. Everybody attaches a certain value or feeling to their money. And if you understand what that is, then you'll be able to make a plan that actually speaks to you and that to help you have the life that you want. All right, step 2, get a professional financial plan. So let's talk about exactly why you need that. So now when I sit down first with clients, I help them figure out what is the retirement goal, how do they actually want to live, and they can choose that lifestyle ahead of time. And then I look at what they're doing before I meet them. And you know, most people are going to be way short. They're going to have like 20 or 30% of the nest egg they need to have, to live the life that they want. And the truth is, it doesn't just happen. It takes some planning and it takes some effort and to be able to get there. Now, there's some good news and bad news about financial independence. The bad news is you need a lot more than money than you think. So do you think $1 million is a lot of money? You probably think it's quite a bit of money. However, $20,000 a year is probably not a lot of money, right? So $1 million today, or $1 million 20, 25 years from now, will get you about the same as 20,000 of today's dollars. So it's not really a lot. So you probably want more than that. So the way I get that is we have a rule called the 4% rule. It's sort of an industry standard that's mostly true if you invest effectively, but basically it means if you have $1 million, and you can take 4% a year, which is 40,000 a year, and then you can increase it by inflation throughout your life, and it should last throughout the rest of your life. All right. Now, if you're talking 20, 25 years from now, the cost of living is about double. So it's only buying 20,000 a year of income for in 20, 25 years. So second bad news is your home is not your retirement. It's surprising how often I hear that. But you know, the truth is that almost all the clients that I've ever talked with want to stay in their home when they retire. So they've been comfortable in there, and you know, they've lived there many years and they're happy being there. They don't really want to move or downsize. And so, you know, if it's going to be retirement, you have to get all the bulk of your money out of it. And downsizing really doesn't clear much. I hear that quite a bit. But, you know, in Toronto here, if you sell a 3,000 square foot house and move into a 1,500 square foot house, you're only going to clear maybe $200,000 or something like that after all is said and done. And it hardly makes much difference in your total in your total retirement, maybe $5,000 a year, and you've taken a big step down in your lifestyle. So your home is not going to be your retirement. And the good news, it's easier to get there than you may think. So, and that's what this thing called the magic of compounding. So to build up $1 million 30 years from now, you may think, oh, that's, you know, being a millionaire, that's going to be hard. But to get there, you only have to put away maybe $700 a month. And remember, if you're putting it into RSP, you get 30 or 40% back. So we're talking less than $500 a month, and you can build up $1 million. So it's not as hard as to get there as you may think. Now, what is a financial plan? And I'm bringing this up because not too many Canadians have seen one. So first of all, what it is not. So you may have gone to the bank or some investment advisor, and they give you this thing, and the first page says your financial plan. It's got your name on it, and you flip it over, and there's a one-page investment presentation or a projection. That is not a financial plan. Okay, that's not a financial plan at all. So here's what a financial plan is. I can show you one. It looks like this. And so it actually should have a whole bunch of pages custom written for you, usually 7 or 8 pages at the beginning, detailed explanations, and then after that all the supporting schedules of how you get there. And it should talk about your values, what's important about money to you, the things you struggle with like cash flow and debt, your goals like financial independence, buying a larger home, education savings for your kids, how to protect it like emergency fund, insurance, and estate plan, and then what the steps are to get there, and how to invest to be able to make it. All of that should be detailed in your financial plan. That's what it is. So now the core part is the retirement plan, which is the financial independence plan. And on this page, you look at the left column is what you're spending today by each type of expense, and on the right is a detail of how you want to retire. And this is your chance to determine the future that you want to have. So don't just get there and see what money you have and adjust your lifestyle. It's a chance to decide ahead of time how you want to live. And from there we see, okay, so you want to retire at age 60 and you want a certain lifestyle. So from that we can work out how big of a nest egg you need to get that, and then we can work out what you have to do to get there. And we're trying to find something that's reasonably doable for you now, and yet is a pretty comfortable retirement for you later on. So we're trying to make those things work for you. Now, I get asked a lot about TFSA or RSP, and the one that's better for you depends entirely on your tax bracket today versus your tax bracket when you take the money out. And when you take the money out after 65, there are a bunch of government programs that are clawed back, so there's a bunch of surprises in your tax bracket at that point. But the bottom line is if you have a plan, you know exactly how much TFSA and RSP you need to be able to do and what's going to work better for you, because you actually know those brackets now. So So why do you need a plan? In the end, it's peace of mind that does it. Okay, you're in full control of your money. You're not worried about it, and you're not constantly thinking, should I do this next, or should I do that next, or what should I be doing better, or can I afford this? All of those worries are gone. And think of it as your GPS for your life, because you're going to drive from here to Florida. Instead of thinking, you know, do I have to turn left or right at the next intersection? If you got a GPS, you don't worry about it. You just follow it, right? And then you know it'll get you there. And it's going to be probably pretty well the best route to get you there. And that's what your financial plan is. You've got all those steps worked out. You're confident you're doing all the right things. And what happens is when you have a plan, you start to think differently and you do things differently. You're not making decisions one by one. You actually have this plan, and all the steps are coordinated, and you know that things are being done optimally for you. And there's also a lot of things that you struggle with that seem very difficult short term are actually very easy long decisions when you think about them long term. You'll see throughout this presentation a couple examples of that, and that's a lot of the benefit. And it pays off. So studies show that people that have a plan and work with a planning-focused advisor on average have 4.2 times more money than those that don't. And and I can easily see it from experience. I can see this is exactly true. This study took into account age and income and all kinds of other demographic factors, and it all comes down to doing the right strategies, thinking long term, making all the right steps, doing it all coordinated together by making smart financial decisions. That's how you build the wealth, and that's why it's worth having a plan. Okay, so next one, effective investing. So now this is not a big investment presentation, but there's a few basic things that you need to know about investing, and that's what to be able to be financially independent, and that's what I want to cover. And you may think, stock market's risky, it's all complicated, who do you trust? It's really kind of a mess. So let me just tell you a couple things that you have to know investing-wise. And here they are. There's 4 of them. One is Stocks for the Long Run is a classic book, but you know, the stock market is the best investment vehicle for financial independence, and I'll explain that. You should diversify globally, it's important. Then you can hire the best and smartest to invest for you, and it's a specific reason that's a good idea. And then buy and hold. It takes a lot of explaining, but let me explain why you need those. Now, first I want to get you this concept of safety and security. Now, you probably think safe and secure, that they're about they mean similar thing. When it comes to financial planning, safety and security are opposites. They're the opposite end. So for example, the safe people, what they want to do is pay off your mortgage, buy some really safe investments like our GICs and bonds, and everything's low risk, so what can possibly go wrong? But the problem is the people that do that never really build up much of a nest egg, and they're never actually financially secure. So financial security comes from having this big nest egg, you know, $2 million investment portfolio. That's what financial security is, and that's how you achieve financial independence. So it's the opposite of being safe. Now, there's a kind of a quirky line we have: be an owner, not a loner, and I'm bringing it up because there's a lot of wisdom in it. And so just a little background, just so we know what we're talking about. When I'm talking about stocks, I'm talking about what stocks really are is they're buying shares of companies, big companies that are on the stock market, and so you're actually a part owner of those companies. Okay, so it's not the market overall. You're buying these stocks. And we also call them equities. You're an equity owner within the company. Versus a loaner, if you're buying bonds or GICs, you're loaning money to companies or to the government or to the banks. And owners make more money than loaners, and that's why it's worthwhile being in the stock market. And this slide really shows it. So let's say you want to have $50,000 a year of today's money 35 years from now. All right, so it seems like a reasonable number. Now to do that, you need to have $2.5 million 35 years from now in future dollars. Now to get there, here's how much you have to invest. So stocks, you know, maybe a long-term expectation might be 8%. Bonds and GICs around 2%, and then a balance. Most people tend to be balanced, you know, some growth, some safety, and are around 5%. So with stocks, you have to put away $13,000 a year. And remember, if it's RSP, it's 30 or 40%. You may get that much back, and it's under 10,000 a year that you need to put away. So it's an achievable number. If you're more conservative, balanced, then you got to put away 26,000. It's twice as much you have to put away, but maybe possibly still doable. But now you have to work for it. If you're doing it in GICs and bonds, you're just never going to get there. You have to put 49,000 a year in, only so that you could take 50,000 a year out 35 years from now. It's just crazy that it works that way. So this actually just shows why you need to be in the stock market. And they are the fastest growing asset class. So this slide actually goes back to January 1975. And I picked these numbers because this is the average house price at that point in Toronto was 53,000, and now it's a little over 700. But if you put that same amount of money in the stock market, you'd have here between 4 and 6 million today. So in the last 40 years, the Toronto stock market has had 6 times the growth of Toronto real estate. And that period of time is, to my knowledge, the best ever in real estate, and yet a little below average as far as the stock market goes. And you look at other things here like gold and inflation and GICs, they're all down around the same thing. Even our GICs have had about the same growth as real estate the last 40 years. So, but now I'm showing this slide because I get asked a lot of real estate questions lately, and I think that people have forgotten because it's been a little while since the last real estate down market. So people kind of think real estate only ever goes up, but we've had 3 major declines in the last 65 years. In fact, a third of that time, Toronto real estate has been going down, and right now things are kind of high, so that probably can't go on forever. But I'm not sort of predicting any crash, or anything like that soon. And the reason is it's always very hard to predict short term. And so people struggle now, should I buy a house, and the prices are going up, and should I ride that, or are we going to have a crash? And it's a short term decision, very hard to make those decisions, and nobody really knows what's actually going to happen short term. But you make it as a long-term decision. So long-term, even if you buy, and let's say you buy a home and the prices go down and drop like they did in the 90s, 30%. But you just stay. What do? You just stay in your house, and in all likelihood, it's going to come back over time. It always has in the past. And the same thing with the stock market. The stock market has their down periods. Here you see the yellow periods are the bear markets where it's gone down, and the gray are the bull markets where it's gone up. So you see, it fell 27, 25, 35, 39. So these are down percent. So these are down periods, and then all the gray periods are where it's growing. And we call them the bull markets. And the secret to building wealth is not to avoid the down periods. People always panic. Well, there's going to be another down period. Should I be more cautious? What should I do? Just forget all that stuff and just stay in. The secret is to be in for all the gray periods, all the bull markets. And I study professional investors. I can tell you, I've never met anybody that can successfully avoid these yellow periods without missing out on huge parts of the gray periods. So that's the important part about it. Just be in it long term. So, and this actually shows you, surprisingly, the difference between short-term and long-term. So this measures standard deviation if you're a math guy or an engineer, but it's a measure of risk. And you see, if you're short-term, 1, 2, 5 years, 10 years even, stocks are fairly risky, and they're more risky than bonds and GICs. But when you get to longer periods of time, like 20 years, stocks are actually more consistent. They're actually less risky than bonds. This is after inflation. And the reason is, bonds get killed by inflation. Historically, whenever inflation goes up, bonds get killed. Stocks have actually been able to adjust for anything that's happened in the last 150 years. Like eventually they adjust. So here's again the picture of short-term versus long-term. This is the last 150 years of stock markets, and you'll see 3/4 of the years are up, and there's lots of gains over 20%, a lot more than you may realize. More than 1 out of 3 years is a gain over 20%. There's also a fair number of losses and some fairly big ones. So if you're looking at this and going to say, well, let's guess what the next year is going to be, it's pretty hard to be right about that. But now let's go to 25-year periods of time. So this is the stock market in 25-year blocks of time. Notice how consistent it is. It's always done well in the long term. In fact, the lowest one is 5% a year, which was way back in the 1800s. and the lowest in the last 80 years, it has been about 8% a year. So, which is why it may be a reasonable, long-term explanation or expectation now. But the point is, again, you think long-term, you don't worry about the ups and downs of it, because if I just buy and stay in for 25 years, I'm going to have done quite well. So bottom line, stocks are the best investment to build financial independence. And you should have the biggest allocation to stocks that you can tolerate. You have to be within your risk tolerance, because you can't sell when it goes down. Or even switch to more conservative investments, but you should try to get educated and have a bigger allocation. Another thing is you should be globally invested. You can't just be in Canada. Canada is just 3% of the world's stock market, and if you look at the pie chart on the right there, we have 75% of our market is in just 3 out of 14 sectors. Basically, we're rocks, trees, and banks, or resources and banks that make the money mostly off of resources. So, in my opinion, the Toronto stock market isn't even a core holding. If you have in investing, we talk about sometimes core and explore. In my opinion, the Toronto index would be an explorer. It's a resource, essentially a resource sector fund. You go globally, you have much bigger, more solid companies. It's much more diversified. It's a much more effective way to invest. And there's been more growth over time as well. So now there's a thing called home bias, which is buying in your own country, and every single country does it, and it's a mistake in every single country. So surprised to find a few years ago there's a big financial crisis in Iceland. We found that almost everybody in Iceland had all their money in Iceland companies. And my first thought was, there were companies in Iceland, I actually can't name one. So, and here's another reason why. So this shows we're now 8 years into the current bull market in stocks since the last down period, and Canada has been relatively flat for the last 6 of them, but while the U.S. has continued to go up. So you generally and the long-term charts show that too, that globally in the U.S. tends to have higher growth than Canada over time. Third thing is you need to find a good, solid method to invest. And I think the most effective way is to actually focus on the fund manager, not the fund. So you hire the fund managers. And that's the cool thing about investing is you can find the all-stars and you can pick your own all-star team and they'll invest for you. So you don't have to try to figure this whole thing yourself. All you got to do is figure out one or a few good fund managers that you're confident in skill and go with them. And every field has exceptional people. Investing is no different. And it's a lot easier to identify them than to be them. So I can tell that Sidney Crosby and Austin Matthews, in my opinion, very superior hockey players. For me to try to be as good as them, never going to happen. Same thing investing. It's very, the stock market is complicated, and I can tell you from knowing it in depth and talking with exceptional fund managers and money managers, when you really understand the stock market, it's more complex than you think. But you can find the very smartest people, and they'll invest for you. And so that's my entire investment process. I don't try to pick sectors or make any predictions of whether it's going up or down, other than long term. I don't pick countries. All I do is study fund managers and how do you figure out who's got skill. If they did well, was it luck or skill? And I've found a bunch of ways to be able to identify it, and that's my entire investing process. And I think I've gotten quite good at doing that over time. And one of the methods is the most in-depth study ever done on fund managers versus indexes is a study called Active Share by a couple Yale researchers. And so what they found is that the reason the average mutual fund makes less than the index is because most of them are closet indexers. So there's one factor that fully explains the entire phenomenon. So, but there are what they call high active share fund managers, where they're 80% or more different from the index. So they're not being closet indexers tends to protect the fund manager's job. That's why they do it. But those are not your good investors. Your good investors are the ones that are very active. And what the study found is if you take the ones that are 80% or more different from the index, then most of them beat the index, and it was predictive of the future. So that's one of the factors that you could look at. But it just shows you that it is worthwhile to be able to go that way. All right, effective mindset. Now, I was talking about, 8% rate of return on the stock market, and what if your returns long-term have been less than that? And you think, well, that's not really happened to me, so how come I'm not getting that same kind of that same kind of luck? And the reason is there's one gigantic mistake that you and or your advisor are probably making. It happens for the vast majority of people. And here is what it is. So this is, we call this the emotions linking with the stock market, and the bottom line is investing and emotions don't mix. So if you look at the emotions, it starts off with rising with optimism and confidence and euphoria, and then the market starts to go down. So you have denial, panic, capitulation, and then things start to go up again. You get relief and optimism and back to confidence. And so now if you look at this graph, it's a little hard to tell the gray shaded areas, but what the mass of investors did in 2002 and 3 and then 8 and 9 is when they dumped their investments. So when everything was high, everybody bought, and so they buy high, then it goes down and they sell. Oh my God, it's going down, let's sell. Then, oh, it's going up, oh, let's all pile in, and they all buy high, and then again it goes down and they sell low. So you buy high, sell low over and over again, and that is the big mistake that you make. And that's why we have studies like this Delbar study, which shows the average mutual fund in a 20-year period made 9.1%. However, the average investor in those funds made only 3.8%. And they're in those exact funds. So that's entirely because they bought high and sold low. And lots of studies tend to show that the average investor makes about 1/3 of the return of the investments that they own. And so the trick is, the thing that you have to look for is the words doing well. So here's how it happens. You go in and talk to your advisor or the bank, and they say, oh, you should buy this fund because it's doing well. Bad. That's what you got to watch for. So it's doing well, so you buy it, which means it's high. Then a year later, the same advisor says, well, you know what, we should sell this one because it's not doing well. We should buy this other one, which is doing well. So you've just sold low and bought high again. That's the big mistake. So how do you fight that? The effective mindset that I learned from a guy who was like a mentor to me is faith, patience, and discipline. So you just have this, optimistic long-term outlook. You have faith that things are going up long-term. So when things look gloomy, when you have a bad market crash, you don't have to know how it's going to be okay. You're just going to know that it's going to be okay, and you just stay with it. And you have the patience to go through it, to wait, and the discipline to follow your plan and just keep doing it. Whatever the market does, you just keep following your plan, and you get there anyway, because the market works itself out over time. Now, there are some really effective strategies that can help you get there that I'm going to touch on only very briefly. And so what if you can't reach your goal? Okay, so you've done your retirement plan, and here's, to have the retirement that I want, I have to put $30,000 a year into RSP. I don't have that much money. So what if I can't do it? So there you have 4 options. One is you can work longer, either full or part-time. You can retire on less. You can find the money somehow, make some cuts in your spending and be more frugal and find money to invest. Or you can try some effective and maybe more aggressive strategies, or some combination of them. But you got to find something that is reasonably doable now and still, gets you to your financial independence goal. Now, there's a few strategies that I'm going to show you in a minute, and I'm not really going to explain them. The point about this is just to identify with you what they are, and then you can go back to my blog site if you want to learn more about any of these. But these are the best ideas for different kinds of people that I've found out there from all of my experience. So now these are all the strategies. So I'm going to spend like 10-15 seconds on each one, just kind of defining what they are. And you can ask me later on, send me a note if you want to know anything more about them, or there's articles on my blog. So first one is RRSP Gross-up. This works for pretty well everyone, and it's an easy way to invest 40 to 70% more into your RRSP without using more cash flow. And here's a simple example. Let's say you've been putting $1,000 a month into your RRSP, you get $12,000 a year. So if you're in a 40% bracket, you would get a $5,000 refund and you can go spend it. So, but instead of doing that, or you can invest the refund. But what if you can do what's called a gross up in February. So you put a higher amount in February. There's a formula to figure it out. So you put 8,000 in February, and now your refund, instead of being 5, is 8,000. So you borrowed on a credit line in February, you get it back in March. It's just a 1-month thing. And now what you're doing is you're putting 1,000 a month away, but you're actually investing 20,000 a year. So it's a great way to be able to help you get there. The next plan, this is what millennials are doing. This is what they should be doing. Now, most millennials are doing things the same way that their parents are. They're putting, X amount, maybe putting 10,000 a year away and slowly to save. And there's a problem with putting away a regular amount of money like that to build up your financial independence nest egg. And the problem is called last decade risk. So if you're putting in 10,000 a year, and you invest it, in stocks over time, what happens is 80% of all the money you have invested from over, let's say, age 25 to 65, 40 years, 80% of all the investments that you have are in the last 15, after age 50. So when you're young, you've actually got hardly anything invested. Before age 50, the truth is the rate of return you make hardly even matters in the long-term scheme of things. You have so little money invested. So there's a study, again, a couple of Yale researchers, called Lifecycle investing, and you're diversifying across time. And just so you get the concept, so Peter is doing it the traditional way. He's building up money slowly. At age 30, he has 100,000 in stocks. At age 60, he has $1 million. So Paul does something that seems kind of radical. What he does is he takes a 300,000 investment loan at age 30. But then he slowly pays it off and then starts shifting over to bonds. So he only has 700,000 in stocks at age 60. So the two of them actually had the same amount on average in stocks throughout their life. But the difference is Peter had all of it at the end. Paul had it spread out evenly across time. So Peter's much more susceptible to last decade risk. And what the researchers showed through past history, this process gives you a 99% chance of a better retirement. So this is what millennials should be thinking about. The Smith Maneuver is for homeowners. So if you're a homeowner and you want to invest more towards your financial independence, you can use your home equity to invest rather than your cash flow. And what this process does is it slowly converts your mortgage into a tax-deductible credit line over time. So the bank will lend you 80% of what your home is worth. As your mortgage goes down, you borrow back from a credit line which is tax-deductible, and you end up with, at the end, 20 years, 25 years from now, you've borrowed 80% of your home value, all to invest towards your retirement. So it can make a big difference in your retirement nest egg. You're borrowing to invest, which is risky, but it's tax deductible, so it's a good strategy for some people. So, and here's a picture of what it looks like. So let's say at age 40 you start the Smith Maneuver. So the blue line is your mortgage going down, the purple line is your investment credit line going up, and blue plus purple is yellow. So yellow, the total debt is actually staying the same. And that builds up this red line, which is your investment portfolio. So you built up, in this example, $500,000-$600,000 additional investments for your retirement, and it didn't use your cash flow. So this is entirely on top of RSPs and TFSAs and whatever else that you would do. This can be all on top of that. Now, there's actually many ways to do Smith Maneuver. There's 7 categories of strategies, and you can do it large and small. But I just want to show you there's lots of ways to be able to do that. Now, there's a strategy called Rempel Maximum, which is what I've put together for some super wealth builders, and I've met some people like this that just want to. They're very aggressive. They're very confident, and they're not going to panic and sell out, and they're just really focused on wealth building. So what they do is they become frugal, super frugal, and they really super savers, and then they put it all in the stock market, and then they look at ways to borrow to invest the maximum they can qualify for. They can do Lifecycle investing or Smith Maneuver or just investment loans or whatever method gives them the maximum amount. They're trying to get the maximum investments. And so this is for hardly anybody, only the super wealth builders. But I have a story on my blog of Joe and Rich just showing an example of how much of a huge difference it can make for someone who actually really pushes it and goes all out to trying to build wealth. The cash jam, this is for people that are self-employed or are landlords. So it's a way that you can make your home mortgage deductible as a business expense or a rental expense. And so basically what you do is you take your business, you take your gross sales, you pay it down on your mortgage. Meanwhile, you borrow on a credit line to pay all the business expenses. Same thing, you take your gross rent to pay it on your mortgage, you borrow to pay all the rent expenses. And so this is CRA specifically allows this. So this is not an investment plan. So the risk, there's no investment risk, and you don't get the investment long-term gain either, but it's a pure tax strategy that can get you additional tax deductions. The holding corporation strategy is for business owners that have a corporation, and there it can be a very effective thing to do you can use your corporation or a holding company as an RSP. So basically it's a 30 to 35% tax deferral. And what you do is you leave your profits in your company or move them to a holding company, and you pay yourself essentially only dividends, and you invest inside the corporation. And this saves you $5,500 CPP if you're single, or $11,000 a year if you're married. Plus, so overall the strategy, you have to invest tax efficiently, but overall the strategy can be more effective than taking out salary and using a lot of RSP. Now this is for retirees. Remember we talked earlier about the 4% rule. So what I've done is a ton of research on it. I looked back at 150 years of data for stocks, bonds, and inflation, and I looked back to see how often. So so we're looking for the maximum reliable retirement income. I have $1 million. I want to take $40,000 a year out, and I want to increase it by inflation. Is it going to last me 30 years or not? So the numbers here, if you look at the column across the 40 for the 4%, it depends on how you invest. So those that were mostly in equities were 96, 97% historically of the time the money would have lasted at least 30 years. But the ones that are heavily in bonds, which is, a lot of times they say, yes, you should have your age or age plus 10 in bonds, and so they end up with 70% in bonds, or something like that, 70, 80%. Now we're talking about 69 or 86% success rate, so it's actually much lower. In the bottom part here, I have the highest success, the highest rate that you can go and still be successful. So to be a 98% confident, if you're an equity investor, you can take basically 4% a year and be 98% confident you're not going to run out of money. But if you're a more conservative investor, it's more like 3.5 or 3% that you should take out. So now that's if you're just taking it out. What I looked at all kinds of ways of managing it, different rules, and when you increase it and when do you not, and there's different formulas for doing that. And I found that you can actually take 5 or even 6% a year out, and if you manage it right, you don't always increase it, and you sometimes decrease it a little bit, but there's a specific formula that I worked out, and you can have a 100% success rate of not running out of money, but take a higher amount out. So it's a good idea for retirees. Now investing, you can get basically 3 kinds of investment incomes. You can get interest, dividends, or capital gains. But the lowest tax of all is deferred capital gains. And it's so capital gains, generally about the same thing as similar taxes, dividends, depending on your tax rate. But if you can pay them 20 years from now instead of now, deferred gains, that's the lowest tax. So how do you invest to get deferred capital gains? And so this section is for retirees, again, trying to minimize tax when you're retired. And it's also for dividend investors, if you're a dividend investor. So we have this thing called self-made dividends. And they are better than ordinary dividends in every single way. So basically what they are, self-made dividends are, you just take your investments, invest effectively for growth, and you just sell a little bit each month. That's a self-made dividend. And they're better than actual dividends because you pick the amount. You can change it any time you want. You could take a 4, 5, 10% dividend if you want. And the tax on it is lower than they would be on Canadian dividends, but you're not stuck investing just in Canada, right? So a dividend investor tends to have all their money in Canada and has this home bias problem. But with self-made dividends, you can invest globally in smaller companies, and yet I can have a 0% dividend, so I don't pay any tax now while I'm building up my net worth. And then once I reach financial independence, I will snap my fingers on that one day. My dividend rate goes from 0 to 5% a year, and I got a nice comfortable income, and that 5% a year I pay lower tax than if I had dividends. So self-made dividends sounds easy to sell a bit, and people somehow don't think it works, but it does work. Now, some of these strategies, I just want to give a bit of a warning here, because some of the strategies I just mentioned are borrowing to invest, and this is borrowing to invest is how all the wealthy people got there. It's also how lots of people lost money, so it's both both a very good and a bad thing to do. Basically, it's a power tool, and you have to know how to use it effectively. And so it's only right for you. You should only consider it if you would be able to stick with the strategy long term. I'm talking at least 20 years. And when there is the next crash, you will never sell or even switch to more conservative investments after a down market. Now, if that's true about you, then these strategies might work for you. If it's not true, then these strategies are too risky for you. Step 6, having a planning-focused advisor. So let me explain why that's important. So the first thing is it pays for itself. It is worthwhile. So studies consistently show people with advisors have a lot more money and they grow money much faster. And so you may think, oh, isn't it the opposite, that maybe it's people that have money that go find advisors? Maybe that's what the studies are telling you. But that's not it either, because what the studies show is the longer you're with an advisor, the more times more money you have. So people that are with their current advisor or with an advisor for about 5 years on average have 2.8 times more money than those without an advisor. And those that have been 15 or more years with an advisor have 7 times more money. So the longer you are with an advisor, the more times more money you have. And it's worth it. Being with the advisor, does actually get you there. And that's just a general investment advisor. There's an even bigger advantage of being with a planning-focused advisor, where they're looking at your overall situation. And again, I showed this one before, but those people that have a plan and working with a planning-focused advisor have 4.2 times more wealth than those that don't. And so being with an investment advisor is shown to be better than not. Being a do-it-yourselfer that does your own kind of plan is helpful, is also shown to be beneficial. But the best is to be with a planning-focused advisor and have a plan. And see, it pays for itself. You have way more money by doing it. And the reason is you will make smarter decisions. When you have a plan, you do everything differently. You've now exactly like where you're going and what steps you have to make, and you're not sidetracked by all kinds of ideas. And you think long term, and these hard decisions become easy. And you're working with an advisor, so whenever you get tough situations, they can talk you through it. And how do you make all these complicated financial decisions throughout your life? So, and you know what? It is actually worth paying for a plan. And this concept might be new, but to get a really good plan, you should really pay for it. And so what you're looking for is an unbiased professional plan. You write a check, you actually pay money for a plan. And that's the reason that's good is because you don't want it to be part of a sales presentation or something that's biased. You want something and you want it to be a real plan, not the fake plan I told you about before, a real plan. And you think, well, so is it really worth the money to do it? And so you can't look at the cost of what it costs to buy it today. You have to look at, over the next 20 years, if I pay some money now for a plan, 20 years from now, am I going to be better or worse off from doing that, buy a plan and work with an advisor? And I think you'll find almost for sure you'll be way better off with it. So here's what I charge. I'm very open about what I charge for anything. So a basic plan, for most people, I charge $2,500. Actually, it takes me about 30 hours work in total, so it's a lot of work to be able to do. And this is suitable for most people, and it's like that comprehensive plan that I showed you. If you're a very complex situation like corporations and a bunch of complicated strategies or very high growth or more complex in some way, I may charge $3,500 or more. But and also, you may be in a situation where maybe it doesn't make sense to have a plan now. You haven't settled into your long-term lifestyle for millennials or something, or maybe you have specific issues. And then what we'll do is we can estimate the time and we block it out. So what I do, fairly often is I'll maybe charge $1,000 for a 4 hours of time, and then basically work through the process of creating a plan. But I don't actually write a plan. We just kind of think it through and go through all the numbers and decide what to do and make some notes, but don't really formalize or write the plan. And that may work for you as well. I also have a value guarantee, a partial value guarantee, and it could be because you've probably never seen a plan before. You think, is this really a good idea? Like how beneficial? Am I going to regret having done this? And so what actually happens is once you've done the first planning meeting is quite long. It's about 3 or 4 hours, but it's fun because even people who don't like finance enjoy it because it's all about your life. And at the end of that meeting, you'll have a good idea of where the plan is going and what's kind of going to be in it, and then you'll see how comprehensive the process is. And at that point, if you don't think it's for you, or you don't want to proceed for any reason at all, I will refund half your money for you. Okay, so that's my value guarantee. We're both basically taking half the risk. I've spent quite a bit of time by that point. I've been offering this guarantee for quite a while, and you know what? Nobody has actually taken me up on it, because once you've been through the first meeting, everybody sees the value of doing it. And on my site at rempel.com, become a client, you actually will. There's a fee-for-service planning tab. There's more information on there. I also, if you're not really sure if this is right, you're not really sure what to do, I offer a free 30-minute consultation for anyone who's been listening to this video. And so we can just sit down and just talk about your situation. Does it make sense for you to get a plan now, or what process, and just kind of see what your situation is and how you could benefit from it. And we can also find out whether we're a fit to work together. I'm not someone who's desperately looking for new clients. Got lots of clients and lots to do. So I only take on clients where I'm confident they're going to work with me a long time, and I'm going to like working with them, and it's going to be a good fit. So we just have an open conversation to see whether we're a good fit. And again, there's more information on my blog, unconventionalwisdom.c, on the fee-for-service advice tab. Now, so that's the actual plan. So once you develop a plan, what happens after that? So, and it's worthwhile having a lifelong money guide that helps you through everything and adjust your plan and all the things that happen. So that's why I came up with the full service options. So as a full service option, I help you implement your plan. We revise it and review it every year, or whenever things change, and revise it if necessary. I do your tax returns, which means I can give you comprehensive tax advice within it. I refer you to all-star portfolio managers based on all my research, so we get the top investors, and I work with you throughout your life, all the issues that come up, and answer all your questions and make sure that you achieve that financial independence that you're trying to get to. And so again, I'm open about what I charge. There are a few options of where to go, but my fee, whichever option, is 1%. That's what I charge, and I always try to pay for myself, even though I think there's a huge benefit of being with me, just the benefit of the planning and working together. However, on top of that, I try to actually pay for myself, costs you nothing. And the way that I do that is through the investment selection. I'm choosing portfolio managers where I'm confident that in the long term, they're going to make as much as the market or the index over time or higher after all fees, including my fees. So basically then if that's happened, I've really cost you nothing. And I'm here to help you, and you get all the benefit of working with me. So now there's a number of options I have, but here are the two main ones, and it's goal-based investing that will actually get you to your financial independence. First one I call it Index Plus program, and it's a very unique pay model. It's a portfolio manager that charges almost nothing and makes almost all of his money based on his performance above the index. So it only charges 20% of what he makes above the index. He charges a base 2.25, which basically just covers his cost. So he doesn't really make anything unless he beats the index, and he's willing to put his money where his mouth is. He's got a 10-year track record now of beating the index by 3 to 4% a year, depending which index. So the idea is, after his fees and mine, and you're still 1 or 2% above the index, and that's that's what the goal is. The other option is an investment manager that's got a portfolio of different all-star fund managers. And each one of these I know them personally, and I believe them to be skilled, that they're outperforming based on skill. And so again, I'm pretty confident that all these guys will do better than the index over time, even after all the fees. So, all right, okay, so we're hiring the world's best investors. We're looking for above index return after all fees, including mine. And it's a really important thing to have one planner for the same reason that you don't have 3 family doctors, looking after different parts of your body. One is better. One that knows your overall position and coordinates it all is the better way to go. And the bottom line is, why do we want to do all this? Why do we want to create a plan and put all this money away and go through all this effort? And the reason is, it's about your life. This is how you take control of your life and you get to that financial independence that you're looking for. So quick review, the 6 steps to become financially independent. You have to understand your inner motivation so that your plan is meaningful for you. It's worth getting a professional written financial plan. It pays for itself. And now you know what a plan is and how it benefits you. To get there, you need to invest in stocks and globally, and you can hire the all-stars to invest for you. This effective mindset, faith, patience, and discipline, your mind can actually really mess you up if you think like a traditional person going with their gut. Faith, patience, and discipline is how you get there. There are some effective strategies that might help you if you need, and you should work with a planning-focused advisor. It more than pays for itself, and it makes sure that you're set on your course. So, and again, I have offered this free 30-minute consultation. If you go to this fee service advice tab on my blog, you'll find there's a link to this 30-minute consultation, or just send me a note that you're interested in it, and that's my offer to you. So, bottom line is, I wish you all the best in your journey to financial independence.